Many of you have asked me about my opinion on Tesla stock, as the stock has been on a horrible start in 2024. It's down to $183 per share. Now, this is a stock that I don't normally cover because I try to not talk about things that I don't understand. This is why I don't talk about AI, because I don't understand AI and I'm not really comfortable with high-tech kind of stuff or something like Tesla and the potential of robots or whatever. I'm not really good at that stuff. So I try to avoid talking about things I'm not comfortable with. But in this video, I'm going to do some valuations on Tesla and just look at the company in general as the core business model, which is EVs and vehicles and stuff. I'm going to take a look at all of that and give you my fair value on Tesla and give you my conclusion. So I really hope you enjoy it. Now, in terms of Tesla itself, I mean, a lot of people say it's overvalued. And some people have extremely optimistic targets like $2,000 per share. Some people believe Tesla is going to $50 or $40 per share, just what it was in pre-COVID, which was around $58 per share. Now, for me personally, if it was just based off sentiment, I would buy Tesla right now. And I really count on sentiment whenever I'm buying a stock, because a lot of these great companies like Amazon, like Tesla, like Google, like Apple, they will pretty much never bottom on fair value. They always bottom above fair value because everyone is trying to catch the same thing. So you always have to somewhat pay a premium for these companies if you're buying them in a crash. They very rarely bottom on fair value. They tend to bottom on bad sentiment. And I think the sentiment is very bad for Tesla. I see how the narrative is shifting. You could look at a lot of the Seeking Alpha authors. I mean, some of them are good, but a lot of them are getting pessimistic, of course, whenever the stock goes down. But if the stock goes up, they are optimistic. This is how it works. But a lot of them have the same narrative. Bad start for 2024. It's going to get worse. Just growth troubling and all these kind of things. But this is normally the best time to be buying when things are not too great. This is my investment philosophy and I've always followed on it. So if it was just based off of sentiment, I would have bought Tesla already. But there's much more to it than just sentiment. In terms of latest earnings, they missed on EPS, 71 cents versus 74. They also missed on revenue. It wasn't good at all. But the worst part, in my opinion, was the total automotive revenue growth, which was only 1%. Now, this is a company used to grow automotives around 20, 30, 40, 50%. This is why it used to trade at 100 times earnings and then went from 100% to 1%. But you still have a lot of things that Tesla cannot control. One of them is interest rates. A lot of people finance these cars. Tesla doesn't have a affordable EV model, EV kind of vehicle. And some people finance the EVs and interest rates are very high. So this is not optimal to a lot of people, a lot of families. So this is hurting them. And Elon Musk did say that he would expect something much worse in 2024 if interest rates don't sharply come down. So this is something that Tesla doesn't control. And it's only 1% growth, bad macroeconomic outlook in general. In terms of energy generation and storage, it's up 10%. Services is up 27%. Pretty amazing stuff. Services could end up being something amazing for Tesla, kind of like how Apple was, the iPhone, and then you had the services, and services were much more profitable than the iPhones. Pretty amazing stuff. Gross profits have disappointed. It's down 23%. 23%, very bad. Gross profit margins have been declining over the last few quarters since the beginning of 2022. It has been declining every single quarter, and I'm not seeing getting better. It could potentially get worse. And this is with the cost of goods sold per vehicle declining. So they have been declining that much, and the gross profit margin is still declining. This is very concerning to me. And I think the high margin period of 25 to 30% is gone. I think between 13 to 16% is likely going to be the new normal. We don't know where these margins will stabilize. This is something we have to watch for. But in terms of gross profit margins, it has been declining. Very bad stuff. So you have declining gross margins. And you also have 1% growth within the core business model, which makes up around 85% of revenues for the most expensive company in the Magnificent Seven. You look at the price to free cash flow, 91 times for Tesla. This is forward free cash flow. Amazon at 25 times, Apple at 27 times, Google 25, Meta and Microsoft, Meta 25, Microsoft 45, and Nvidia 34 times. Tesla is the most expensive at 91.5 times price to forward free cash flow, which encourages some growth in it. 91 times. This is very, very high. So out of the picture, it looks like Tesla is somewhat overvalued. But again, this is not enough, and I'm extremely bullish on the energy storage and solar services kind of sectors. They have been growing massively, not in terms of profits, mainly in terms of revenues. Although gross profits for services have been improving, it was losing money in 2021, 2022 they turned profitable. 2023 is much better. This is a higher margin, lower capex kind of thing in the future. So this is something that I like in terms of Tesla. Tesla is starting to face some competition, mainly from BYD. BYD has been surprising Tesla and many other companies, and now BYD has surpassed Tesla for the most EVs sold. So this is something pretty interesting and it's something concerning. And I'm not sure what will happen eventually in Europe and the United States. If Europe and the United States are going to try to put tariffs on Chinese cars to try to support, Volkswagen's EVs in Europe and maybe Tesla's EVs in the United States, they want to try to support local companies for EVs. If they put high tariffs on BYD, then the problem could be solved and it would not be a much big problem. But if they don't do that, these Chinese cars, they are very cheap, very affordable, and the quality doesn't seem to be bad so far in terms of BYD's cars, and they could seriously hurt Tesla and other companies like Volkswagen. They're trying to do EVs and many other companies in Europe. So unless the government takes action and they put some kind of high tariffs on these Chinese cars, it's a very big concern, not just for Tesla, but for many other companies that want to do EVs. Now, Tesla is trying to finally come up with a more of an affordable model of the Tesla. It's called Tesla Redwood, I believe, coming in 2025, around $25,000 per EV. This is going to be a game changer for Tesla. It's going to be very affordable for a lot of families, and it's not going to be as affected by interest rates as it is. Most people buy $20,000, $25,000 cars, even if you have higher interest rates. But whenever you're talking about 60, 70, 80,000, I mean, that's not as as valuable as something like 25,000 whenever you have higher interest rates, of course. This, I believe, is going to be a game changer for the company. But I'm not sure about the margins. I mean, they have been declining on the higher end, the lower end model. I'm not sure what kind of margins Tesla can put up on a $25,000 EV. Now, one thing that I really kind of don't understand and I really like with Tesla is you have a lot of call options. You have the call option on the Tesla Cybertruck being a massive success, which is starting to roll out. You have a call option on the Optimus robot, which can pretty much fold laundry and fold clothes for you. It's not perfect, but they're working on it. I mean, and within 5 to 10 years, these kind of technologies, I mean, could be game changers for a company like Tesla, for the valuation, for the growth, for everything. If EVs were slowing down, you have the robots picking up. If they do it within Tesla, I mean, this would be a game changer for the company. And this is just a call option. So this is not something you have to price in the model. A lot of people price it in the valuation. I personally don't. I just look at the core business model, the services and the EVs, and everything else is a plus for me. So this is how I look at it. And you have a lot of many different call options within the licensing of the AI kind of stuff and autonomous driving, and you have the Optimus robot. So many different call options that could end up being huge successes for something like Tesla if they do work out. Now, in terms of Elon Musk, and it's mainly that he wants 25% of the vote control for him to expand AI within Tesla. And if he doesn't get 25%, he wants to try to do it outside of Tesla. Now, this could be concerning, and I'm not sure what the board is going to do. I don't believe there's going to be massive dilution, because they're not going to issue all these shares and give them to Elon Musk. They will likely give him some kind of a special shares or super shares, kind of like Constellation Software has with their companies. I mean, they can give them, for example, 1 or 2 shares, which have like 200,000 shares worth of voting power or something like that. I'm not sure if they're going to do it, but if they don't do it and Elon Musk takes the AI technology out of Tesla, I'm not sure how much is priced in within this potential, within the market cap, but I think a lot of growth is priced in the market cap, over 600, I believe 580 billion. So I'm not sure how this is going to play out, but I'm just going to not waste your time a lot and mainly look at my valuation model for Tesla, which I believe is very fair. In terms of growth numbers, I looked at the analyst growth numbers, and from 2023, 2024, pretty much to 2028, they have around 14%, 24, 15, 21, so around 20 to 22% average revenue growth. So I put it in at 20%. Net income margins, they have it going up from 10% in 2024 up to 13.8%, in 2028, over 30% expansion in net income margins. Now, I was more conservative. I only put in 20% revenue growth, which can end up being more in the future if you have something with a robust, or if the new EV, 25,000 EV picks up, it could be much more than 20%. It could be 25 to 30%. But I put in 20%. I haven't used a expansion in margin to 13%. I kept it at 10%, which is the lowest margin it had in a while in 2024 is gonna expect it to be. So I kept it at 10%. PE ratio is now trading at 56 times forward earnings. Now I'm going to use two PE ratios. The first one is 30 times. The next one is 40 times. A lot of people believe that Tesla should be trading at 15 times earnings because Ford is trading at 8 times. Now, I think this is not smart at all. I don't think this is going to happen. This is something that a lot of us do. Whenever the stock is going down, we get too pessimistic. We try to price in the worst ever case scenario, and then we find reasons just to not buy the stock. And when the stock recovers, we say, oh, I was too conservative. I wish I did this, and I wish I did that. So I think a lot of people are being unreasonable if they are comparing Tesla to Ford or to GM. I mean, I would never do that, to be honest. So I believe between 30 to 40 times earnings with all the potential is fair. It could be 25, but I'm using 30 times. Now, using 30 times earnings, this is only 24% on the upside if you buy Tesla today. And for me to get 15% a year or to double my money, I would have to buy Tesla at $113 per share. Now, if Tesla does trade at 40 times earnings, if everything becomes a success, the Cybertruck becomes a success, the $25,000 EV becomes a success, the AI stuff stays within Tesla and it becomes a success, I mean, it could trade at 40 times earnings, and I would never bet on it. But if it does trade at 40 times earnings, then I still have to buy Tesla around $151 per share for me to get something like a double over the next 5 years or a 15% annual return. So for me personally, even if you want to use 20 times, a lot of you like the 20 times earnings. If you do use 20 times earnings, you would have to buy Tesla at $75 per share for us to get it double. And this is the problem with these companies. They're just so volatile. You have the Elon Musk premium, and we don't know what this premium is. I mean, we don't know how it fades, if it gets better, if it gets worse. I mean, it could be at 20 times, it could bottom at 30 times, it could bottom at 40 times. So it's very hard to find like some kind of a same exact bottom like you can find with Coca-Cola or Pepsi or something that's a little bit more predictable. But for me personally, as I looked at 3 different case scenarios, I think Tesla now is still somewhat expensive. Now, it doesn't mean that the stock cannot bottom. It can't go up 20%. But on valuations, I think it's expensive. It is due for some kind of a recovery, in my opinion, and it could potentially go lower as the company continues to likely miss on EPS in 2024. I mean, I don't see it getting better unless interest rates just drop like 2 or 3% on the Fed funds rate, which is unlikely to happen anytime soon. And, this is what I think. For me personally, if I had to buy Tesla, I would not pay more than $150 at the best case scenario. So I would maybe open a position, 120, 130, very small position, and dollar cost average down. I don't think Tesla is going to $50, and I don't think Tesla is going to $2,000. And I just a little bit more reasonable, I think, and I believe I could get around a 15% annual over the long term if I buy Tesla at under $150, $140 or below. So this was just my opinion on Tesla stock. It was not financial advice, of course. I hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.